Welcome to week 1 of Accounting Principles, and our first topic today is accounting as the language of business. Now, the learning objectives for this concept video is number 1, describe what accounting is and the primary forms of business. Explain the meaning of some of the terms such as assets, liabilities, shareholders' equity or stockholders' equity, revenue, and expenses, and as well to state the basic accounting equation. To begin with, accounting has been defined as the process of identifying, measuring, and communicating economic data that helps people who are outside the business as well as people inside the business judge how well the company has been doing. Now, this is called financial accounting. There are two branches. There's financial accounting and managerial accounting. Financial accounting deals with the recording, summarizing, and presentation of financial data. And it's all data, or it's all information about transactions that have happened in the past. Now, the way in which we record and summarize and present this information is according to a set of accounting standards that are recognized all around the world called the Generally Accepted Accounting Principles, or GAAP. Question: why are you taking an accounting course? You're probably in college or university at the moment, or even in senior grades of high school. But you're taking an accounting course. Why? Well, most likely because you will be working in a business at some point in time. And many of the terms that business people use are terms that have been adapted from the accounting process. So Accounting Principle course teaches you the language of business. These are the terms that we will be using, or business people use. So we must understand what they are. First of all, the first textbook ever published was published in 1494. And it was published in Venice, Italy, by a monk called Luciano Pacioli. And he published the Summa di Arithmetica, Geometria, Proporzioni, and Portantillantia. And to my Italian friends, I apologize for my accent. However, you can see that the language was the language of that time. The vernacular was the spoken language of the day. And in this book, he described a method of bookkeeping that the merchants used in Italy at that time. And that system that he published is known as the accounting cycle, and it has not changed in over 500 years. He, Lucia, described journals and ledgers, and he also warned people not to go to sleep until the debits equaled the credits. Well, here we go. What's a double entry accounting system? What are journals and ledgers? What are debits and credits? These are all terms of his time. His ledger had accounts for assets. What's an asset? Accounts receivables, inventories, liabilities, capital, income, and expenses. Now, all these words have come into the English language, but they come from that time period. And that is why we will be learning that language and the double entry accounting system. So Lucia Pacioli is widely considered the father of accounting. Now, we're going to be doing the accounting for who or for what? Well, what we are doing is the accounting for a business entity. Now, a business entity is something separate from the owners of the business. So we are going to analyze, record, summarize business transactions only of the business, nothing to do with the owner, except if the owner put money in the business or took money out of the business. In each case, that's what our purpose is here, to do it separate from the owner. Now, as background then, I apologize for this overhead here. It's moved on me and I can't fix it. We're going to look at, are basically 3 types of business and no more. There's what's called a sole proprietor. And that is a business that is owned by one person. And he's the same person who owns it and generally manages it. And it's easy to set this up. You just say, I'm in business, and that's you don't have to inform the government that you're doing this. But there is no distinction between you or the business. The assets, well, we don't know what assets are yet, but the debts of the business are your debts. Okay? Now, contrast that with a partnership. A partnership is the same as a sole proprietorship, but it consists of two or more people. And again, the debts are shared by the owners. There's no separation between the business and the owners. Now, the major type of business forms, and the one we're going to be using in this course, is the corporation. A corporation is a business that is incorporated under the laws of the state or the country, and are owned by as many as one or two or a few shareholders, or up to, in the case of public corporations, thousands and thousands of stockholders. Corporation is unique in that it is a separate business entity. The owners of the corporation are the stockholders. They buy shares in a corporation, and we call that shares stock, which are units of ownership. And should the corporation fail, the owners would only lose the amount they paid for in their stock. That's not the same for sole proprietor, and it's not the same for a partnership. Now, briefly, there are three types of companies. There are service companies, and they perform services for their customers for a fee. That's the simplest type of business transactions, and we will quite often analyze business transactions for a service company because it's a little more simpler than a merchandise company, because a merchandise company has inventory. That is, they purchase in goods, which we call inventory, and they do nothing to change those goods. They simply put a price tag on them and put them on the shelf or hang them on the rack. That's all they do. Of course, they sell them for more than they buy them. Then later on in your accounting, you will take accounting for a manufacturing company. A manufacturing company buys in materials and puts it through an operation or conversion process, and then produces a product and sells that product to other companies. So those are the three types of businesses. To begin this course, we're going to be talking mostly about service business. Now, some of the language that Lucio Pacioli used when he published his books. And this is the language you use today that business people talk about. So you must understand what these terms are that have come into the English language. First of all, when we talk about the assets of a business, we're talking about what the business owns. Okay, those are the resources that the business owns. These are things of value owned by the business, such as cash, machines, equipment, building, trucks, and so on. So when we talk about asset, we're talking about what the business owns. When we talk or use the word liabilities, we are talking about what the business owes. The business owes some money to people outside the business because they use their money to purchase some of the assets. Now, another word for assets is resources of the business. Another word for liability are debts of the business. Okay, so we keep those two clear. Now, the third is stockholders' equity. Now, the stockholders put money in the business, recall that. So they have an interest in the corporation. Some of their money was used to buy assets. Some of the assets were purchased by borrowing money. So the owner's interest in the corporation is basically the difference between assets, the value of all the assets, and the liabilities. Okay, if the assets were $100,000, liabilities were $40,000, then the shareholders' equity would be $60,000. And this is all reported in a financial statement called the balance sheet. This lists the company's assets, liabilities, and shareholders' equity at one particular point in time. And we'll talk more about the balance sheet in the next concept video. But as far as the language goes, the balance sheet is also known as a statement of financial position. And the balance sheet equation is as I put up here. Assets, total assets, are equal to the total liabilities plus the total shareholders' equity. Okay? Now, when I use the word transaction, a business transaction or event that is an exchange has happened here. And it's a measurable exchange, and it has changed the accounting equation. That is, there's been a measurable change in either the assets, liabilities, or shareholders' equity. But because it's an exchange, two things have happened in the balance sheet equation, and we will analyze that again later. Revenue. Now, we hear people say, okay, what's the revenue? Is simply the amount of business earns. And it earns revenue when it sells a product or provides a service to the customer. Now, many people think when they start accounting that revenue is the amount of money we get in. Well, that's partly true. I can provide a service or sell a product, but the person is going to pay me later. I didn't get the money. But at the time I provided that service or sold the product, that's when I earned revenue. If the person's going to pay me later, that means they owe me. I owe you. So they're going to pay me later, but that's an asset. And we call that asset accounts receivable. Nevertheless, keep in mind that we in the accounting business record revenue when the business earns it, not when it receives the cash. Many times they receive the cash at the time they earned it, but sometimes they don't. Expenses, contrasted with revenue with expenses, are the costs incurred. I paid rent, I paid salary, I used gas or petrol or what have you to deliver my service or my product. These are costs incurred that help me earn my revenue. Okay? These are costs that have been consumed in serving my customers. Now, we put these two together in the income statement. This is a financial statement that shows the amount of revenues, the amount we earned, and it also shows the amount we spent in earning that revenue, and we subtract one from the other, and that is what we call profitability, or the profit of the business. Now, the term is profit or net income, or sometimes we refer to it as earnings. Okay? That's all revenue minus expenses. And this money belongs to the shareholders, so we keep a record of that in a financial statement called retained earnings. Retain means to keep. And if the business keeps the earnings, the net profit, they keep it in this account called retained earnings. It's not cash, but it just shows you how much of the earnings are owed to the shareholders. And that is, the retained earnings is accumulated net income. Now, if I paid back the shareholders anything, that is called a dividend. A dividend is simply the term that means that the company has paid back to the shareholders some of the money that it had earned in profit from operations. Now, the income statement is also called a statement of operations. Statement of retained earnings is the financial statement used to explain what changes have taken place between two balance sheets. And we will talk more about that later. So as I said, profit, net income, is the amount by which revenues of a period exceed the expenses. This is also called profit, earnings, and so on. Now, if the expenses are greater than the revenues of the company, the company's in trouble. It has incurred a loss, and it cannot continue to go year after year, continue incurring a loss. That means spending more money in trying to earn revenue than the amount of revenue you earn. Some terms. Now, if I owe suppliers and I am the business, if the business owns suppliers for goods or services, that is, it purchased some goods from a supplier that it's going to use in their business, and they're going to pay them later, well, they have an account with that supplier. The supplier is allowing them to pay later, so the supplier has given them an account. And we call that, what we owe them, accounts payable. That's the amount that we must pay the supplier sometimes in the future. That's a liability. Okay, so this is a type of liability. This is also a debt for us. Now contrast that with accounts receivable. At the same token, we allow some of our customers, we provide them the service, we allow them to pay us later. And so therefore, they have an account with us. We know them, and we give them an account, and they're going to pay us later. So we're going to receive it later. So that is called an accounts receivable. Now, other terms, when I use the term stockholders, I could be using the term shareholders. It's the same thing. Both of them are owners of the corporation. Sometimes it's just preferable to use stockholders, sometimes shareholders. And lastly, as I said before, when the company earns a profit and pays it back to the shareholders, it does so in the form of a dividend. So a dividend payment, usually in cash, to the owners of a corporation, it's a distribution of income rather than an expense for doing business. This is not an expense. Okay, so those are your accounting terms. They all come to you courtesy of Lucia from 1494 Venice. And you're basically learning the language of business. Okay, we will move on now to financial statements. Yeah,